Let's talk about 3 ways to build a $1,000 per month dividend portfolio. But let me start with a story of how I started my investment journey, the origin. When I started investing back in 2014, I did what everyone did. My goal was to create a dividends portfolio that could pay me $1,000 per month in distributions so that I can have the passive income to feel financially free. So I opened a CDP account via a brokerage back at that point and bought stocks directly to be held in CDP. And back then, I think CDP accounts were more common, and I paid around $25 per order. That was the commission to buy a CDP trade. So in order to minimize the commission percentage, I try to make each order a minimum of 5,000 Singapore dollars, which is quite a big deal for a university student like me back then. Now, more about that story later, but the goal was always to build a $1,000 per month dividend portfolio because I strongly believe in that narrative when I was younger. You see, $1,000 is a nice rounding number, and you can say that you earn 4 figures per month passively. And this number could cover 30% of a fresh graduate salary back then. So it was quite nice. But to come up with $1,000 per month, it is highly dependent on the dividend yield. And that dividend yield will then determine how much capital or assets under management that you will need to generate this amount of dividends. And to be very honest, the capital required may vary by such a huge amount, like 6-figure amount. And that is ultimately dependent on which stocks or ETFs that you pick. Now, I want to be very clear that I do not recommend stock picking, especially for beginner investors who just step into the investing world. And maybe that's why I prefer passive investing through index funds. But for a dividend income strategy, I do agree that it will require some stock picking skills. So in this video, I'll share 3 ways that you could build up this dividend portfolio and my thoughts on each strategy. But please note that I cannot provide financial advice and I try not to be prescriptive. So by the end of this video, hopefully it can help you build up your framework of how you should structure your dividend income portfolio. And remember, everyone's situation is different, so you have to assess your own risk appetite. And if you are new here, hi, my name is Chris, an ex-chartered accountant, now a personal finance YouTuber, and do follow me on my Instagram. We only have 4,000 followers there for more financial insights. Now, strategy number 1, that is 100% STI ETF. The Straits Times Index tracks the top 30 largest companies by market cap listed on SGX, the Singapore Exchange. And in SGX, there are 2 dividend distributing ETFs. The first ETF is ticker ES3, State Street STI ETF, with a dividend yield of 3.08%. And the other ETF is ticker G3B, Amova Singapore STI ETF, with a dividend yield of 3.34%. So for the purpose of this video, I'll just use G3B as an example because it has a slightly higher dividend yield. And to hit $1,000 per month, and that will be $12,000 per year, you could just simply do a simple calculation. $12,000 of dividends divided by 3.34%, and that will give you $359,000 of capital required to make $12,000 per year or $1,000 per month of dividends. So the good thing about buying STI ETF is that all the 30 STI component holdings can be bought in just one trade. Whether you want banks, telcos, industrials, and a handful of REITs, it's all already baked into the index. So my thoughts is that this strategy is going to be the lowest dividend yield of the 3, and hence it will require the highest amount of capital. But remember, it also comes with the lowest amount of effort and more diversification compared to the other 2 strategies that we will discuss later. There is 0 stock picking involved, and dividends are paid out twice a year, semi-annually. And the good thing about ETF is that you can just buy 1 unit of ETF, unlike other STI stocks where there is a minimum of 10 units or 100 units, and it is much easier for a smaller size order. So this thing about smaller size order relates back to my story, because somewhere along the way, I transferred my CDP holdings to a custodian account platform with lower trading fees of around 10 Singapore dollars per trade. And it was quite a simple decision back then because it was lower commission, which means cost savings, and that means I could size my orders smaller and do smaller frequent orders. So this benefit kind of outweigh the convenience of holding it in CDP. And the truth is that when your holdings are in CDP, you cannot see it in your brokerage account. You need to log into the CDP account statement to view your holdings. And I still remember the whole transferring process was very manual. So I was still working my corporate job back then, and during lunchtime, I had to visit the bank branch, take a queue number, wait for my queue to be called, go to the relationship manager, fill out some forms manually, submit the form, and then wait for a few weeks until the whole CDP transfer is completed to the bank custodian account. And you can see that this is a very inconvenient and long process. What's more, it's manual, so you need to physically visit the branch. But I guess it was necessary back at that point because I really want the benefits of having lower trading fees. That was all in the past already, but do you know that you can now transfer from CDP to Moomoo fully online without going through all the steps that I did previously? And here's how to do it. Firstly, open the Moomoo app and tap on the magnifying glass, then search for CDP Share Transfer. Next, confirm your CDP account number and select your receiving account on Moomoo. Then confirm your personal information and choose from 2 transfer methods, and digital transfer is preferred. Then you can choose from full or partial transfer. Once everything is completed, review the form and sign to confirm. Lastly, you have to wait for processing, but it's quite fast, from 3 to 5 business days compared to my weeks of waiting back then. Now, there are 2 main benefits to transfer your stocks from CDP to Moomoo. Number 1, you save on trading fees because Moomoo commission plus platform fees total up to around 0.06% for Singapore stocks and ETFs, which means around 3 Singapore dollars on a 5,000 Singapore dollars order. And that is much lower than traditional brokerages. Number 2, you can manage all your holdings in one account, whether they are for Singapore, US, Hong Kong, or Japan. So it's good for rebalancing your own asset allocations. And the good news is transfer in 10,000 Singapore dollars or more to earn transfer in rewards, where you can get 88 Singapore dollars of trading cash coupon, Singapore stock 0 commission card, and 1 lucky draw chance to win up to 2,000 Singapore dollars of holiday fund, plus up to $3,500 of trading cash coupon or iPhone 17 Pro Max. Please note that terms and conditions apply, and if you are new to Moomoo, there are welcome rewards that I will share more later. Now we move on to strategy number 2, which is the top 5 stocks of the Straits Times Index. So let's venture deeper into stock picking, and we carefully select the top 5 stocks listed in the STI ETF. So using their weighted average in the STI ETF allocation, I'll calculate a new weighted average for just these 5 companies, which are DBS, OCBC, UOB, Singtel, and SGX. Do note that all these are approximate numbers because their numbers fluctuate every day. So my overall allocation will be 42% DBS, 27% OCBC, 15% UOB, 10% Singtel, and 6% SGX. Total sum up to 100%, so it's weighted average. And here are the following dividends trailing 12 months yields that I got from Moomoo app. For DBS, 4.16%, OCBC 2.84%, UOB 4.11%, Singtel 2.99%, and SGX 1.68%. So if you calculate the blended portfolio yield according to the weightage, you will come up to a blended yield of 3.53% per annum. And the capital required will be 12,000 divided by 3.53%, and that gives you 340,000 Singapore dollars of capital required. So this dividend yield is slightly higher than the STI ETF that we mentioned earlier in strategy 1, and hence there's lower capital required. But now you are carrying single stock risk, and that means that any bad news surrounding the company or one dividend cut could just hit your income directly. Remember that you also need to monitor the financial news, the business outlook, and all their performance of these 5 individual companies and read all their financial reports instead of just passive indexing through the STI ETF. And this is the reason why I really do not prefer stock picking. Even if you could save 5 figures of capital, the idiosyncratic risk is not worth it. And finally, let's move on to strategy number 3, where it's the top 5 REITs of the S-REITs Leader Index. So REITs stand for Real Estate Investment Trust, which is a portfolio of properties that pays 90% of profits to shareholders. And for the benchmark, we will use the CSOP IH S-REIT Leader Index ETF, which is ticker SRT. And we look at the fund and holdings, we just find the top 5 and give them equal weightage. So the 5 REITs that will be in this portfolio are CapitaLand Integrated Commercial Trust, Keppel DC REIT, CapitaLand Ascendas REIT, Mapletree Logistics Trust, and Frasers Point Centrepoint Trust. And to find out their distribution yield, you can go to your Moomoo app over the REITs homepage and you can get the following yields, which is 4.19% for C38U, 4.58% for AJBU, 6.08% for A17U, 6.22% for M44U, and 2.62% for J69U. All these are their ticker names of the REITs that you can find on Moomoo app. So if I calculate a simple average yield, equal weightage 20%, that will be 4.74% per annum, which is very high, right, compared to our previous two strategies. And hence the capital required will be much lesser. At 12,000 divided by 4.74%, you will only get $253,000 of capital required. And that is the smallest capital of these three strategies that we just discussed. And yes, you may think that out of all these three strategies, this is the one that is easiest to achieve because the capital is so low, 253,000. But this is a strategy that I personally do not advocate for. You see, REIT prices and refinancing costs are highly interest rate sensitive. A lot of them rely on periodic equity fundraising that dilutes existing shareholders through rights issues or private placements. So your DPU or distributions per unit can get squeezed, even when the underlying property portfolio is still doing fine. So personally, I invest for total return and not just on dividend yield. So this does not fit how I build my own portfolio. But if you're comfortable doing the homework on all the research, the gearing, the sponsor quality, and the DPU sustainability, and read all their financial reports and their business outlook, then this strategy may still work for you. So let's have a quick roundup. I gathered 3 strategies that could help you build that $1,000 per month passive income through dividend distributions. Number 1 is a 100% STI ETF portfolio with a capital required of $359,000 at 3.34% dividend yield. Number 2 is a blue chip portfolio of the top 5 STI companies at $340,000 of capital required at 3.53% per annum dividend yield. And finally, the REIT strategy. The top 5 REITs portfolio will need $253,000 of capital at 4.74% per annum of distribution yield. And if you forgot everything I just said or just want a quick summary, I already summed it up in the Ko-fi cheat sheet that you can download for free on my Ko-fi shop. No need to pay me anything, right? Just download it for free. However, I must also stress that the higher distribution yield or dividend yield also comes with a higher level of potential risk. Now, whether the increased yield compensates for the increment in risk, you have to make your own judgment and do your own due diligence. Strategy 1, STI ETF portfolio, requires the most capital, but it's the least research intensive and monitoring that you need because it is just tracking the index. Strategy 2, the blue chip stocks, they require less capital, but it puts a lot of weight on 5 individual companies, which also has idiosyncratic risks. And finally, strategy 3, the REITs, they require the least capital, but they carry other risks like interest rate sensitivity and dilution risk to existing shareholders. So I would say you can pick the best strategy based on how much capital you're willing to commit and how much monitoring and research that you're willing to put in, because you cannot just look at the dividend or distribution yield. And I totally understand that dividends feel like income. They feel really shook because you feel like you are receiving extra income every quarter or every half a year. But really, total return is the one that builds your AUM, your assets under management, over the long term. Don't just chase for a dividend yield number. Chase for the number that would really grow and make sense over the long term, especially if you are much younger, because you really do not want to disturb the compounding effect of your long-term assets versus keep taking out money from dividends. And if you're still sitting on your OCBC holdings that haven't been touched in years, do try out Moomoo CDP Digital Transfer. Especially for new to Moomoo users, you can receive some exclusive welcome rewards using my special link to sign up, or you could just search for a special deposit on your Moomoo app and key in my special code HMSG999. Because you can get up to 1,200 Singapore dollars of welcome rewards, which includes 100 Singapore dollars of bonus NVIDIA shares when you fulfill the requirements as per the terms and conditions. So check the link in the description or scan the QR code right here to get started with Moomoo today. And if you haven't watched my video on investing, my 10 golden rules to help you get started on your principles, then you can refer to my previous video on why Singaporeans lose money investing right here.